Welcome to Bendigo Bank's market update for February, with our views and updated forecasts for global markets and the domestic economy. This month we'll have a look at the RBA rate hike decision and the latest jobs, housing and inflation data, and the recent surge in the Aussie dollar above 70 US cents. The RBA rate hike yesterday to 3.85% was no surprise by the time it was announced, but caps off an extraordinary U-turn for monetary policy compared to where we were in mid to late 2025, and marks the shallowest RBA easing cycle in history, only 3 cuts peak to trough, totalling 0.75%. Our view at the end of last year was that the RBA board would not hike rates unless core inflation rose above 3.5%. So this rate hike wasn't in our forecasts in December. However, the latest jobs report did change that equation, with unemployment unexpectedly falling in December to 4.1% against our and the RBA's forecasts, suggesting that demand for labour and resulting inflationary pressures will be more persistent this year. The RBA are now expecting unemployment to remain between 4 and 4.5% for another 2 years, while we remain more concerned about disruptive risks to labour markets due to emerging technologies. But jobs data remains a key leading indicator. Headline CPI is back up at 3.8%, while the RBA's preferred measure of core inflation, the trim mean, is around 3.33%. Not that far above the 2 to 3% target band, but when combined with recent jobs data, household spending and housing trends, too high for the RBA Policy Board's risk tolerance. Housing was a major contributor to the recent rebound in inflationary pressures via rental prices and the cost of new dwellings. And the latest home value index from Cotality for January showed another rise for dwelling values, up over 9% in the last 12 months on average for capital cities and over 10% for regional values. The pressing need to add more supply hasn't abated. As well as this unwelcome rebound in inflation and interest rates, global markets have endured a turbulent start to 2026, with geopolitical tensions around the world and speculation about US interest rates and who would become the new chair of the US Federal Reserve. This all saw a rise in oil prices and an extraordinary jump and subsequent fall for gold and silver prices. But one of the beneficiaries of this question around confidence in the US dollar has been the Aussie dollar, rising to almost 71 cents last week before a pullback, along with commodity prices. The higher exchange rate is something we've forecast here and on our Business Insights website for some months, but this rally has been slightly ahead of schedule, much like the timing of RBA rate hikes, which we had expected in 2027 rather than this year. But more positively, the higher exchange rate will be helpful for inflation and is one of the reasons we still expect stable RBA rates for the balance of 2026 and a firm exchange rate, leading into a jump in growth and productivity for our economy in financial year 2027. And that's the market update from Bendigo Bank.